Well, good morning. Good morning. If you would be so kind, if you follow me on Twitter, I'm doing something that I should have done yesterday. Check to see if the audio is okay. Can you guys see that I have a NASDAQ chart up here? And if you give me the okay that the volume is good, a simple 5 by 5 would be sufficient. Appreciate it if you could. Momentum Trader, thank you. Chummy, thank you. Thank you, Tyler. All right, so before we get into this, it's very, very important that you understand that what I'm going to discuss today is absolutely not to be intended as trade advice, not financial advice. It's simply a warning. Okay. I'm going to read price as if I were interested in taking a live trade. I'm not going to take a live trade. I'm going to explain to you what I see in price action and the delivery of price and what I would expect. Now, let me preface it by saying that I actively, ongoing teach that this day, out of all the days of every calendar month, this is the day that I have no confidence that even with my concepts would be able to deliver the precision that I would expect and demand of it in other days, because this day is many times used with high levels of manipulation, okay, and manual intervention where the market itself is being pushed beyond the normal boundaries of what would be reasonable. Now, if there ever was a time when the market can be random, it's during manual intervention. And there are times in the calendar month where you need to be aware of that. And it's usually when there's a rate announcement, very large impact news drivers like CPI, the non-farm payroll, and the Thursday prior to non-farm payroll. So here is non-farm payroll Friday. The classic idea is that because it moves around a lot, or it has a tendency to sometimes, because sometimes it can just do nothing. A lot of excitement, leading into the 8:30 news driver that's going to release here in about 19 and a half minutes or so. That idea of chasing the quick, fast movement, it's treated as a lottery ticket. Okay, so if you're brand new as a student, or if you're brand new as a trader, and you don't have a model, you don't know what you're looking for, it's advised that you don't touch this day. In fact, try not to do any trading at all on Thursday or Friday of the week of non-farm payroll. If you have a model, if you know what you're doing, then obviously, and I've shown examples of this as well, my students can do it as well. After 10 o'clock of non-farm payroll, everything resumes and you can be a trader after that. But it's important to understand that there are specific rules to this when you're brand new. And these are days where, and hopefully I'll explain something today and expect to see something perform a particular way and it not work. That's what I'm hoping to do. Okay, I've tried to do this several times in the past where I've talked about the non-farm payroll live, and I've been right more than I wanted it to be, because it doesn't really communicate the level of concern that I try to preach to you that you should have about it. So I'm hoping, since I think no, next month will be the last non-farm payroll together. I'll live stream that one as well. So if I get it right or wrong on this one, at least we'll have one more opportunity, in November to see it live, where I'm outlining what I think is going to happen. So with all that said, just please be careful. Don't take anything I'm about to say as an invitation to get into a trade, or view something as a confirmation of something you've already assumed might happen. Okay, I'm probably going to be wrong this morning. And that's usually something I don't like to say too much, because I'm confident in my concepts and my models. But this day is kryptonite, because it literally can do whatever you don't think it's going to do. and you may miss a trade or get hurt in a trade, and it causes toxicity. So it's just better to let it not be a factor for you at all. From a psychological perspective, one trading day or two trading days out of a month, around a high impact driver, not touching it is not going to be the end of your career. It's forming discipline. It's good, sound money management. It's preservation of capital, and it's not gambling. That's the number one tenet to it. You're not trying to gamble, okay? All right, so we're looking at the NASDAQ. Before I look at this one, because I'm going to be focusing on this specific market, but I want to quickly look at the ES. Okay, and I was up overnight watching the London sessions because I had every expectation to come out here this morning like I'm doing. And I was watching, and I wish I would have mentioned it now, but some of you probably already were looking at it. But these clean highs on S&P, I was kind of hoping they were going to leave those intact ahead of the non-farm payroll number. And if it would have been the case that they would have left them in play, in other words, if it didn't run up like it did here, that would have been the initial draw at 8:30. Now, since it has done that, it's ran for buy side. Traders are now caught long. And there is an inefficiency right there. See that? So when I look at non-farm payroll, and this is what I'm telling you, you should do every single opportunity for you to study non-farm payroll. Not that you should try to trade it, but it's an amazing study on liquidity. It literally is one of the best case studies you can do. And you can back test it, look at old data. But it's better for you to log it on all time frames and back test it through each time frame, looking for what liquidity was taken, how long did it take to move after that liquidity was taken. So long story short, what I'm saying right now off the cuff, just looking for the draw on liquidity, I would expect that this inefficiency would be revisited today. Okay, in the sell side below there. Now, does that mean we go down here, then go higher? It could. Does it mean we go up one more time to run this high or one of these highs here and then plunge down there? Maybe. I don't know. I don't know that. So what I like to do is I like to teach the students to look at a 5 and 15-minute time frame. I know this is 5 minute, but we'll go up to the 15 in a second, to outline where the clear liquidities are above old highs or relative equal highs, or below lows or relative equal lows, and what inefficiencies exist above the market price. Right now, market price is at 42.94. So below it, it's this inefficiency on the 5-minute chart. Above this high and this high here. Why this one? Because we have an inefficiency we traded up into and broke lower. It might want to revisit this inefficiency here one more time, touch the low of it, and not take that high. Because we've already done a damage by going above the relative equal highs that I've highlighted here at 43.04 even. And that is on the basis of all these highs here. But admittedly, it's a little too shallow for my liking. So let's play devil's advocate for a moment. Say we do drop down here. It would not be completely out of the ordinary for it to use this area to then rally and go deeper than this high to take the liquid. Because there's a lot of time to leave this many highs there, and just to bump it that little bit and to bump it just ahead of non-farm payroll, to me, is a little suspect. So using this idea, if we leave this inefficiency open and we start running at non-farm payroll numbers release in about 15 minutes or so, if it runs up there and takes that high, then I would expect it to drop back down and use this as the draw. But if we drop down to this first, then I would be watching to see if it wants to make a run back up to knock out those individuals that were already short. And if it were to do that, then maybe a deeper run below this low and work into this inefficiency right here with this mitigation block. Okay, so I teach to use non-farm payroll as a case study, and then you watch price action. You do not demo trade it. You do not live trade it. You don't use it on your funded account challenge. You don't use it to trade your funded account. You don't do it with your brand new live funds in your broker account. Okay. You don't do those things. This is a day where all the rules go out the window. Okay. So it's literally like casino time. It's a gambling session. And because of that, remove any necessity for you to concern yourself with the outcome in terms of a monetary reward or loss. If you take the money out of it, it's a wonderful opportunity to study what price is doing. It's a case study in psychology. Who's in the market right now or overnight from London? It's the longs. So, gun to my head, I think we drop down to stop them out because they've trailed their stop loss here. Then it rallies up and goes a little bit higher here. And then they're going to regret that and they're going to chase it as a breakout. And then they rake them across the close and take out this low and trade into that inefficiency in that mitigation block. That's my gun to my head. I'm willing to be proven wrong today. I hope I am wrong because it'll solidify why I tell you and explain to you why I'm not out here every single time non-farm payroll comes out there and trading with my live account doing it. Because it's probability of hurting me being incorrect, me reading it wrong, or them just simply going in there and cleaning everybody's clock, and mine would be included if I was participating in it. And it doesn't pan out to do anything at all. So it's not worth it for me to try to risk real money to do something when I already know the probabilities are shifted outside of my favor. And that's all I'm suggesting to you. Now, after 10 o'clock, everything resumes the way it is normally. We're back in a normal market condition where you can look for silver bullets and whatnot. You can do the same thing at 2 o'clock to 3 o'clock. So it's not me trying to tell you don't trade on non-farm payroll Fridays at all. When I say don't trade non-farm payroll, I'm saying don't trade non-farm payroll between 8 o'clock and 9:30. At the opening bell, you can resume doing whatever you normally would do. So that way, hopefully I've kind of like cleaned the air about that whole business. I'm going to jump over to the NASDAQ. Okay, and this is the new week opening gap. We traded just a little shy of consequent encroachment, which is the midpoint of that. And I don't see the equivalent for that inefficiency for the ES in this NASDAQ. So this one's a little bit more tricky as a read. Same premise here from London. We've rallied, we've taken buy side. It didn't take that high here. So that's something of my interest for today. Sell sides here. I would expect them to run on that this morning. Do they take it down first to knock out everyone that's trailed their stop loss and has held their position longer? And they're just waiting this out, hoping that it's going to resume higher. It can come down, take those longs out, and they would be able to, I guess, keep whatever they've accumulated in here. Overzealous price action would be a complete rundown, taking out the low from London. If I was making the market, that's what I would do. I would come all the way against them and then send it back up to knock out this high here and then close between the high that forms once taking this high out and the low that is formed after taking this low out, and then trade in the upper 60%, between 50 to 60% of the daily range and leave the close right there. And that's how I close the week. Okay. I think that's about it. Yeah. That high is essentially consequent encroachment too of the new week opening gap. A new week opening gap is simply where we settled on Friday and where we opened up on Sunday. You're probably going to hear my stomach because I'm fasted right now and my laptop is sitting right here with me close to the microphone, so it's probably going to pick that up. Now notice the consequent encroachment level, which is midpoint of the inefficiency that's defined as the new week opening gap. That to me is a level that would be interesting because it's just above this swing high. Okay, so that swing high has buy side. It need not trade above this high. It can. I mean, I could be completely wrong, and it just shoots straight up there and blows out the new week opening gap high. And I'd be able to say, see, that's the reason why I don't trade on non-farm payroll. That's what I'm trying to get to today. Just like I was trying to outline yesterday, I wanted yesterday's premise and suggestion. I want it to be wrong, because it's very frustrating for me to try to keep telling you avoid something because of concern for risk, and then not seeing the things I suggest fail. So it's a little bit of a conundrum as a mentor. I want to show you why you should risk nothing on these days. And then when I suggest something should happen with the expectation I'm probably going to be wrong, I fail at being wrong. So, I mean, I need it to either be this time or hopefully by November. And that way I can leave you with an example saying, okay, see, ICT even tried and he didn't do it right that day. And that's good. That's a good thing. It's a good thing to see that happen. It's reassuring. Let me highlight that level actually before I take it away. All right, and that is new week opening gap, consequent encouragement. New week opening gap, C, E, middle, right. Okay. About 9 minutes to the fireworks. And below this low here, if you haven't already noticed, there's a little inefficiency right there. This is a fair value gap. And specifically, it is a buy side imbalance, sell side inefficiency. That means it's a BISI. Right there. Come on, good grief. Okay. And then we'll look at the consequent encouragement of that inefficiency as well. We'll highlight that at 32 even. Let's do the dot line. Okay, so sell side is below here. And collectively, buy side is layered from this high here, which I'm not going to draw a line on because I want to keep the chart clean. So buy side is above here to here. My son is talking. Top left. That. And back into midpoint of the new week opening gap. Okay. And I have a moment I can do it. I know some of you are saying, what is a new week opening gap? Because you haven't looked at the videos, haven't studied long enough, and maybe you just want everything done for you. This here is where we settled on Friday. That's the closing price. So that makes the new week opening gap low. And where we opened was higher than where we settled on Friday. So that makes it the higher level, meaning that the new week opening gap high is this, which is the opening price at the beginning of the new week on Sunday at 6 o'clock. Okay, so that level, in this level, makes the new week opening gap. And you can see how the market has respected that level, or these levels rather, all week. Okay, and nobody talks about that stuff. Everybody knows about a gap, but once it fills it, they forget it. And the algorithm doesn't forget it. It refers back to it throughout the week. It's not the same thing as a new day opening gap, which is the difference between where we settle on Friday at 5 o'clock and then reopen at 6 p.m. That's new day opening gap. And it's not to be confused with the opening range gap, okay, which is where we have the relationship between the regular trading hours, which is here. We have the 14,857 and 3/4 level. Okay, you want to have that highlighted there. And then you use this. I mentioned this yesterday in a review. Opening range gap, and you started off with settlement. This is the word that's going to change in a moment when we find out in relationship to where market price is. And we'll make it nice contrast where it just stands out. Now we go back from regular trading hours to electronic trading hours, and we're above it. So this means that this is the opening range gap low because it's below it. So you change settlement to low. Okay, just that quick. It's easy. I do this every single day. That's the routine I go through. Now, I'm annotating them on my chart because I want you to see what I'm referring to, so that way you can watch price when it gyrates and either blows through these levels or it respects them between now and 9 o'clock. I'm going to be with you till 9 o'clock, but at 9 o'clock I'm going to kill the live stream, and I'm going to resume my normal every morning practice of watching my favorite live streamers and looking at the sentiment that their chat windows offer me. I don't have these levels on my chart when I'm trading, and it's just for you to be able to see it visually represented. I write these actual levels down, and just by their labels here, this is what I have on a notepad. Okay, they're the simple little, I buy them in bulk at like BJ's or Sam's Club. They're little yellow notepads, they're very small ones, and I write down key levels for the markets that I'm watching. And the levels are the very levels that's being highlighted here. And the description of what those levels are annotated just as I show you here on my chart. I do not have them on my chart. I don't want them on my chart because I want to have a clean canvas. So that way I'm watching price. I might not see something because my attention is diverted to a level I've annotated, okay? So if I have those levels in mind, as it's approaching those levels, I'm aware of them. You know, I'm cognizant of these levels many times before I sit down in the morning session, because there's something that's either going to be carried over from the London session that I've looked at, either was trading or watching, or maybe woke up in the middle of the morning if I wasn't all night long, and then see something that I like. Okay, what level is important. I don't need to annotate this low here, even though it's the London low, because it's inside of this inefficiency, and it's just above consequent encroachment of that inefficiency. Okay, so everything in the chart here is all I use. I don't have any kind of other secret annotations. I'm not looking at any kind of indicators. It really is just reading price. Now, these are the key levels. Let me get this off. This is driving me nuts. That's the little fair value gap I was drawing in the live stream yesterday that you couldn't hear me in. It used it to run up into the fair value gap that set up the short that I outlined and gave a very clear depiction of in the tweet before it was delivered. All right, so we have about a minute and a half, and then the fireworks and regret will come into the marketplace. And those that have offered themselves up on the altar of the randomness gods, they will be flayed. So we sit and we watch, and we want to see, how does it perform? What does it reach for? Does it reach for that buy side first? If it does, then we'll be looking for the London low to be drawn to. Not right away, but over the course of the morning going into like 11 o'clock. That would be scenario 1. If it drops down and takes the sell side and returns back to the opening range gap low, which is most likely the gun in my head is probably going to do that first. Then if it doesn't just stop there, then it'll run for the buy side, and then I'll be interested to see if it wants to come back down for that London low. But ultimately, whatever high we form between now and 10 o'clock and whatever low we form, I think we're going to close in about 50%, maybe just above the 50%, because I'm not confident that they're going to break that daily consolidation range that they have on the daily chart for NQ. They might need to keep it like this over the weekend and then maybe start working with it next week. Whereas we already saw the ES trade lower, NASDAQ's showing a reluctance to do that. I think it'll eventually bend the knee and do what ES has done, but it's being a little unruly right now. So 8 seconds and then watch the fireworks. There you go. Overshot the inefficiency. Went past the opening range gap low. Gotta give more chart real estate here. Hold on. And back down into this. Okay. Now, what did it key off of? And why was I talking about the likelihood it would reach for the lower side first? Obviously, this is way beyond what I was expecting. But we were working off of that new week opening gap low. Notice that? So we worked on that level. Otherwise, you would have never known it. Would have no understanding of why it just did that. And it overshot on the downside. So because of this, I would be more inclined to see, does it have a willingness to get back up and to touch the low of this inefficiency? Because this is a sudden run for this liquidity right down here and the old inefficiency over here. Now imagine for a moment that you were trying to go long today. How forgiving would it be even if you had your stop loss? It would literally have eviscerated you. Like, that's too fast, and you can be so wrong so quickly, your account would be roasted. So it's real important to see how, if you are wrong on this day, if you're wrong on this very report, it can undo you. And if you're lucky and you were short, that type of move is not skill. That's falsely attributed as skill if you take it and say, okay, I made money on that. Because it's a gamble. You don't know if it wasn't going to do this very thing on the upside. I don't know that. You won't know that. So it's important that you understand that that inherent risk is always there, and it should be respected. You should not look at this and say, yeah, I'm going to do 15 contracts on my funded account. This is the day I'm going to do it, because it's going to be the day that you blow it. Let's take a quick look over ES. I hope gold went down to my objective. I gotta take a look at that real quick. ES tanked. Let's see if we got our full grand slam for the week with ICT running out that low. I don't think we got there yet. It's almost there. 1804. That was where we're looking for. Let's go to a 15-minute time frame. I was kind of hoping it would have already done it, but it still might get there today. Who knows? I'm not a gold trader, but I gave you this earlier in the week. I haven't taken that low out either. Let me add that. Not that I want to shorten my objective, because I think this is still potential. But over here, that's the low I like. But if it doesn't want to take that this week, it could probably sweep this one this morning at the very minimum. Okay, let's take a quick look at Euro. sell side. See how clean that is? In there. It's pound dollar. Same thing in here. We have sell side there with inefficiency to the left and a breaker. So be mindful of this one. If we see continuation on the downside, those are your levels for pound dollar. And let's go back to NQ. This is where I think we'll reach for today, and then digging into that daily. Let's go up to the daily chart real quick. This is that inefficiency that's remaining. We dug into it here. We have relative equal lows. I think we'll try to gravitate towards that. If it doesn't do it today, as long as we don't trade above today's intraday high and we don't make a higher high, then I'm going to go into the weekend expecting Sunday, Monday, Tuesday that we're going to be digging into this, deeper into next week. So as long as we don't trade above today's intraday high, we're rolling into this down here. That's how I would internalize it, okay? So that way it's me co-signing, telling you what I think. Now, if you look at what this hourly chart is showing you, we have this fair value gap, which was yesterday's. Audibly, I said it could trade down there, but if I was in a trade yesterday, I wouldn't be holding for that. Now, because it went down into it, reacted off of it, now we went through it. So what does that make this here? A potential inversion fair value gap. So it can reverse and retrace right back up into this morning. I'd like to see it not take these lows out before 9:30. Okay, so here's narrative. I don't want to see these lows taken out yet, and I don't want to see it trade above this and find an attempt to find support at it. I want to see it stay below it, this fair value gap, and then trade up into it at, say, I don't know, 9:20 to 9:45 in that area in terms of time. Then I would expect it to roll over and reach for the sell side with that. Okay, so it's very specific what I just outlined. If it were to do that, I probably would be taking a trade. I won't be with you live, at 9 o'clock, but that would be something I would be interested in seeing. Does it give me the order flow to support that idea? It doesn't support it if we go back above this fair value gap before 9:30 opening bell and we start tapping against it as support. And if it starts respecting it and trading up a little bit, I'm going to sit on my hands and then wait till 10 o'clock to see what it wants to do. Okay, but back into a 1 minute chart. Okay, now look at that, folks. Do you want to honestly risk your account on an event that moved that much? This is one candle on a 1 minute chart. The range high is 14,884 3/4, and it dropped down to 14,705. It's like 180 handles in 1 minute. You can weather that. You can weather that with your 15 contracts on your funded account. You're nuts. You're literally nuts. And this is what can happen. Like, this is literally what can happen. And I know some of you, because I said something about how I believe it's going to trade down to that opening range gap low and then maybe into that inefficiency down here. Some of you probably went short and you caught this big run here. And if you did, you gambled. I'm not going to high five you, and I'll scold you if you show me that you made money on it today. I don't want to see that. I was hoping I was going to get it wrong. This would have been so good if it would have just went straight up after I said I think it's going to go down like that. That would have been perfect for me to be able to say, see, this is why I don't do it. But again, here it is. It's going towards the initial draw. So it kind of like, it makes it hard for me to justify it in some of your eyes because you don't see it failing. You see it, well, he just said it was going to happen, and it did. Man, that's not what I want you to think. I want you to think that this should be respected. And if there's any one particular fear that you should have. You should fear the unknown around days like this, because look how exaggerated it can be. And you don't know what they're going to do because they have control. They want to be able to manipulate, unseat individuals. And we saw, overnight, everybody was buying it up on the London. I felt that London low would be a target, and it went right through that like nothing, like it wasn't even a factor. Just went boom. Took out yesterday's low, boom, it's over. So anyway, this was a whole lot more movement than I was wanting to see. Not so much wanting to see, but expecting to see, say it that way, which is a classic trait of non-farm payroll. It's very hard for me to dial in and have every aspect that I like to look for on any other given day that that prevents me from wanting to put real risk on. And some of you are looking at your calculator right now and saying, if I would have went short at 14,889 right before 8:30, if I just would have went short there, I could have paid all those losing trades back to myself. I could have got funded today. Don't do that. Don't do that. Sorry, I gotta plug this in. I thought I had it plugged in. Take a look at the Dow. Similar. Now, this is a very large displacement to the downside. And it's Friday, and it's non-farm payroll. Generally, I think of non-farm payroll is like a two-stage event, like I teach FOMC is. So at 2 o'clock, you have one direction. And then at 2:30, it does the opposite of whatever 2 o'clock's move was. Okay. Generally, that's the flavor for non-farm payroll price delivery. Usually the event is 8:30. They jam it one direction, and then they start working towards the opposite direction throughout the day. If it's not that, then it's very little retracement and then sudden, continuation of whatever direction it made at 8:30 into 9:30's opening bell. It's a small little retracement of whatever move that was, and then it really accelerates again throughout the morning. If it doesn't do either one of those things, it's going to consolidate. And obviously, I don't think consolidation's a factor for today because it's made a huge run. That's going to have a lot of people wanting to be a participant in that. So the classic depiction would be this. Okay, they see it's traded lower a lot. And people are waking up, they're looking at the market thinking, wow, this thing's really tanked. And they want to see it go up a little bit more. They want to see a little retracement so they can sell short. It might not get that high up into this inefficiency that was created here in 1 minute. They may bump this high, or they may not, because they technically have already did this candle's high here. So we may not see it trade above this high, whereas normally that'd be something I'd be expecting. So because of this, it may just consolidate, leaving this high in play, and then rotate below this low here and just keep making lower, deeper retracements, but not coming back above here, and just make it very hard for people to trust being short and not allowing anyone to capture any kind of long. So basically the entire range was done in 3 minutes for the day, I think, which makes it very difficult to work with. Excuse me. ICT gets tired. When he doesn't sleep, he does. So that was a very animated delivery on NonFarm Payroll. I hope, I hope very much that folks that have been looking at these days thinking, wow, I want to trade them. I want you to really appreciate how fast this thing just moved. And you may not have real-time data, and you're looking at this and your data is delayed. I don't know how long the delay is on TradingView. Like if you don't pay for real time, I don't know what the actual delay is. I don't know if it's 10 minutes, 15 or 20. I don't know, but I know it's delayed. The minimum is 10 minutes. I know that. But your chart's not going to show this, when mine was doing it, if you don't have real-time data. And if you're not expecting these types of moves, if you're not expecting the level of volatility and speed and magnitude and viciousness of it, it can really hurt you fast. Even if you're trading with the smallest of leverage, it's a shocking thing, and it'll completely scar you. And you don't want to be able to get into the market again because it's moved that quick. And what will happen is, because of your infancy as a trader and your inexperience, you'll think every time you get into the next trade, it's going to do this type of move against you. And that's what I mean when I say scar tissue. When you do things that are against the grain, I tell you not to do certain things, and you still do it, knowing that I told you that this is going to probably be the outcome, and it's going to cause you to second guess yourself, have doubts, second guess your model, second guess the concept, second guess your ability to trade using them profitably. That will cause you mental scar tissue. And every trade you get into, you'll anticipate the worst case scenario like this is how it's going to run towards your stop. Or it's going to act like that because you're not using a stop, which it should do that to you. If you don't use a stop loss, you should expect it to do that. That's a fear that's worth holding on to, because it'll keep you from not implementing a stop loss when you should always have one. So we've seen it trade up into the body of this up close candle, the only one since the delivery at 8:30. That's Scout, in case you heard her. And let's put some more real estate on here. Do I not let that show up on a 1 minute? Go back to the daily. Oh yeah, we got a lot of range, sorry. This is the ES. I thought I was looking at NASDAQ. Senior moment ICT. Old man ICT. All right, let's go to a 1 minute chart on this one. Okay, similar thing here, trading up into the body of the up close candle right after. And with more real estate on, just think down here. Okay, that's what I'm looking for that this morning. Now, if it rushes down there before 9:30, that just makes it very difficult. It makes it very difficult, because that means it's already in a hurry. It's in a quick rush to get there, and that reduces the likelihood of probability being in favor of a solid low risk sell at the time of the opening bell or shortly after, going into 10 o'clock. So in layman's terms, and in the simplest format in explaining it, I would like for it to not trade below the top of that inefficiency on the daily chart that we haven't traded into yet. I would like to see it stay hovering like this. And then at 9:30, break a little bit, create an imbalance, and then between 9:45 and 10, give a fair value gap that can be used as a shorting opportunity, and then look for it to gravitate towards this inefficiency. And then how far we dig into that before we close the session for the week and the day, it remains to be seen. But that's how I would anticipate going forward from where we're at right now. The good old new week opening gap. Not in your books. Awfully heavy. Now, some of you may be asking, because you probably looked at the number, how many jobs, what was the number that was expected? I couldn't tell you to save my life what it is. I don't care. When I look at these reports, I'm anticipating the level of volatility that is above and beyond what is a normal price delivery and volatility for a normal trading day. And I don't ever go back to it after the end of the day either. Like, I'm not interested. I could care less about that data because that data is all fake. It's all garbage. The people that are in positions of information, they already know all that data. And they're the ones that are fading that rally up in overnight. That's the smart money. They're selling into that rally. And now they're sitting on heavy wins. And they'll start taking some of those gains as we get below this low here. That's their first opportunity to start scaling out. And they're scaling out now. They're taking some, not all, some of the gains off. And that's what I teach, is running down equity. So when we're bearish, every time it creates a new low and it retraces off that low, every time it digs down below that low or any subsequent low that forms, you treat that as an opportunity to take something off. Just trying to get a feel for why that little shaded area, because I was like, I don't remember putting a fair value gap or anything highlighted at that price level. It's just the overlap between those two rectangles. Let me take that top one off. Okay, heaviness is still here. Again, we're looking for it to trade down into. That's an order block, but that's not what I highlighted. I think this is the relative equal lows on the daily chart. Yeah, that's what that is. We'll change it to a dotted line. Drop back down in. There you go. You can see it. So by having that level, even though we've already swept below it on the daily chart, this level here, I'd want to see it accelerate through this level once you get down to it, and then rush into the daily inefficiency that's shaded in blue. And it's a lot of empty space down there all through here. So it could accelerate pretty nice in the afternoon if it wants to continue. I think that we can get, well, you want to do your quadrants on it. So from the high and the low that you drop your fib on it and get your upper 25%, the equilibrium, or not equilibrium, but the consequent quadrant, which is halfway point of it, in the lower quadrant and in the low. There's really nothing bullish about stocks. indices are reflecting what everybody that has any common sense knows, that all these stocks are at multiples that are unwarranted. And there's a lot of big money that is leaving risk because they know what's coming. Now, I was talking about that last summer, and you're about to see a lot of it start to begin. We're in the month for it to really start showing the signs of real trouble for all of us. Let's take a look at gold. Nope, still didn't get down. Got real close to it though. 10.5. So I got real close to it. It could still run up into this inefficiency a little bit and then rotate lower. That's something that could happen today. Again, I'm not suggesting you should trade it. I don't trade gold. It's very, very infrequently reviewed by me because it's a market that's highly manipulated. A lot of the large firms have been fined for spoofing in this market more than any other market. So if you know that that is a characteristic of that market, and honestly, I've already said this before, gold should be trading at $25,000, not this price. It's so absolutely manipulated, and they're keeping it that way because once all the central bank digital currencies are in play, and we'll be seeing them very, very soon, they will be saying that their currencies are backed by gold, like the BRICS nation. They're trying to instill this replacement for the dollar, and we've never really been challenged before as the global reserve currency, the greenback, since it's been the reserve currency. Nothing's been able to rival it. But now there's this coalition of very powerful nations that are coming together, and they're building this anti-dollar, de-dollarization campaign to move away from the greenback. And their currency is going to be backed by gold, and ours is backed by vapor. The wind, okay, literally hot air. It's got nothing behind it. So once that's established and it's a real thing, you're going to see gold go vertical. It's going to rush to get to its truer value. They're just keeping it artificially suppressed as a result of everything I'm just saying here. So at some point there will be a time where I will be interested in trading it, but right now I'm not so much interested in it because since I know that's the likely scenario what we're anticipating unfolding, I think that they'll sink gold aggressively, scare everybody from wanting to buy it. It'll get deep discount, and dollar will be higher as a result. And then the real undermining of the dollar will happen when gold starts going parabolic and the dollar crashes. But I don't think we're there yet. Let's go ES. Another 2 minutes. I'm going to escape and get my morning prepared to spend with my youngest and review price with him. It's not going to be anything all that exciting, so don't think like, oh, let us please sit in. It's nothing like this. More or less me sitting here explaining how this is a day you don't want to be trading. This is the reason why. Everything I've already said to you. But he's sleeping in today, so I have to wake him up. I'm getting ready so he can sit with me at 9:30. And that's going to be it for today. So I'm not sure if you got anything out of this. If you have been jarred and startled by the veracity of how fast this thing moved this morning, good. That's exactly what you should feel. You should not feel enticed to over leverage on a day like this, because if you're wrong, you absolutely will have your ass handed to you. And you don't want to give the market an invitation to do that, because it will absolutely do it and take more ass than you have. So hopefully you found something out of this insightful. Until I talk to you next time, enjoy your weekend. Be safe.